Good afternoon, everybody. My name is Christina Davidow, and I am the chair for the Global Business Committee at NABOR. I am very excited today because we have a friend of mine as a panelist, Marena Loeffler. She's become a friend, and I have come to learn how knowledgeable she is on everything Germany and everything taxes and everything in between, which is really great because we have her here today as our panelist. Also with her is Elke Drexel. Am I saying that right, or Dreschel?
Appreciate it.
Okay, good. So we've got Elke here as well, and together they're going to give us a very full presentation, as I said, on everything Germany. This is an especially opportune time for us to be hearing about Germany because, as everybody may or may not know, everybody from Europe is now able to travel freely into the United States with less or without any of the restrictions that we had for so long due to COVID. So that's really exciting. We're going to see a lot more back and forth with folks coming from Germany, and I'm very hopeful that we're going to have a big uptick back to our regular numbers of foreign buyers and sellers here in Naples, because pre-COVID, pre-pandemic, there was quite a lot of interest here in Naples, and it was a very exciting place to be because of all of the travel restrictions that kind of was put on hiatus. But now we're getting ready to start again, so that's really exciting. So before I keep everybody busy with my stuff, I'm going to start to introduce Marena. And Marena is Allure International Tax Consulting's fearless team leader. She's best known for her quick wit and an extraordinary memory. After starting out as an assistant tax consultant in Germany, because Marena is from Germany, she took her career to the next level by becoming a CPA in the United States and completing her Master's of Business Administration degree here in Florida. And now she has an amazing business that has, I think, more than, I guess you guys have 3 locations at least, and you can tell us a little bit more about that. But definitely there's some offices here in Florida and also in Germany, which I find is really amazing and certainly helpful to your German clients. So with that, I'm going to give it over to you and let's learn everything Germany. Thank you, Marena.
Thank you, Christina. All right, so Christina touched on my person a little bit. I have it here again. So I've been living in Florida for over 23 years now. Started my career in taxes while I was still living in Germany. So I bring the background of the German tax system with me to the United States. Finished my education in the US and have been running the firm of Allure International Tax Consulting since January of 2005. That sounds really scary, actually. We have 3 offices. The main office is in Bonita Springs. We have a second location in Cape Coral, and then also, as Christina already mentioned, one in Hamburg, Germany, which brings me to the next thing. Our hours of operation are 9 a.m. European time to 5 p.m. Eastern time. So we're almost available for 24 hours. For our clients, 9 a.m. in Europe is 3 a.m. here. So, and our German clients have come to love the fact that they can call us in the morning when everybody here is still sleeping, but they still get an answer from the people that, we have in our German office. We speak multiple languages in our office. We have employees that speak those languages, total of 17 employees in those 2 different time zones. Most of our communication and document transfer is done in electronic means. So we have a portal that we use to transfer documents. A lot of our client meetings happen via video conferences. Some of our clients I've never met in person, so it's normal for us to do Zoom meetings. And one thing that I find is important for you to know also is our first meeting with a client, the onboarding meeting, is free of charge. And I find that to be really valuable to our clients because they can, as being foreigners, they really don't have a lot of knowledge about the US tax system. And when they come to the office for the first time, I give them an overview of what they need to know. Some of it I will talk about today for you guys. So, it's just a step into the door for them to get familiar with what's ahead of them and what they can anticipate in terms of taxes in the United States. So that being said, we'll get started with the actual presentation and the topic. German investors, 5 ways for you to shine with your German clients. And I will be talking about the German culture and how to, what their culture is and what to expect. The 5 taxes that apply to German investors in Florida, an LLC for German investors and what the pitfalls are and the advantages are. I will talk about US income reporting in Germany. And I will also touch on FERPTA and ITINs. And then after that, we will open it up for questions, and you will also have my contact information on the last page of the presentation. Now, I forgot to ask that, but I'm assuming that for the questions, you guys are supposed to type that into the chat box, and then we will address the questions after the presentation. I have a lot of time to do that. So, first topic, understand the German culture and your customer's expectation. The first thing that comes to mind when we think about Germans is be punctual. And what that means is actually being on time is late. So if you really want to impress your German client, be 3 minutes early. They really appreciate that. They appreciate the fact that you honor their time. And it's just the little extra step you can take to impress them. Also, while a lot of them speak English very well, the conversational English very well, understand that it is still their second language. And that is particularly true with real estate related language, tax related language, any industry related language that they're not used to. They don't know what deeds are, they don't understand those terms. So just take the extra time to make sure they understand what you're talking about. That also goes with explaining the process of buying and selling real estate. That process is totally different in Germany. So when you tell them that they need to see the title company or an attorney and that this is the deed and this is the closing and all these things, they really don't know what you're talking about if it's the first time that they're buying or selling. So you're going to have to take the time to go through the process with them, what it means, what they're signing, and all these things. Otherwise, they will be lost. And it's just good customer service for you to explain to them how all of that works. Germany does have a system where property records are located with the courts in a similar way we do. It's still a totally different process going through a closing and the timing on that too. In Germany, it takes a lot longer between signing the contract and actually the documents showing up on the court's website, if we want to call it that. So it's a totally different process. In addition to these items, what I've learned with my German clients is while they are using email and they're all familiar with now due to COVID, they're familiar with Zoom and WebExes and all these things, they still like the person-in-person contact, even if it's a phone call and even if they can't come in or couldn't come in and not have an in-person meeting. They like the personal touch, they like to be talked to. It's a way also to get information across fast. If you talk to them on the phone, they can ask their questions and you can answer right away. So while with the time difference, especially, it is convenient to use email and things like that, they still like the personal touch as well. So that's something to keep in mind to impress your German clients as well. Okay, 5 taxes applying to German investors. So if we look at a German person that buys real estate in Florida, whether it be for their personal enjoyment or what we have a lot with our clients, as a vacation home, a holiday home, where they use the property for several weeks or months out of the year, and then the rest of the time they want to rent it or they try to rent it, there's 5 different taxes that will apply to them. The first one I think you're most familiar with is the real property tax that every property owner in Florida has to pay. That is something that people from Germany are kind of used to. There is a real property tax in Germany too, but it's a lot, the cost is a lot lower than what we're used to in Florida. So that might be something that you want to make them aware of, that this is an annual cost that they have to cover, the property tax that is due every year in the fall. A lot of them aren't aware that that's something that they have to pay every year, and especially that it connects with the property value, and that it can also increase as the value of the property increases. So that is something obviously that they need to know if they purchase property in Florida. The second tax that applies to foreigners that purchase, or Germans that purchase real estate in Florida, is the estate tax, US estate tax. Now that's a topic that right now a lot of us don't think a lot about, because as US citizens, we're used to the fairly high estate tax exemption, which is over 11 million at this point. With foreigners, for a lot of countries, that exemption is only 60,000. With Germany, it's a little bit different because there is a tax treaty in place that covers estate taxes. And with that treaty, Germans also get an increased estate tax exemption, not the 11 million that US citizens get. So this is something that needs to be looked at, whether, and it depends on the value of the assets in the United States, and also the value of the assets, or their net worth actually, outside the United States. So it's a little bit of a complicated calculation to come up with the estate tax exemption that would apply to them. I have seen many clients where the estate tax exemption is not enough, and then we have to talk about ways to minimize the estate tax, or ways to handle that. So that is something that is really important for you guys to know too, and tell your clients when they buy real estate in Florida that this could be something that they're subject to, and that nobody really wants to think about. The third part is federal income tax. If your clients buy property to use as a vacation rental, or as a long-term rental for that matter, so if they generate income with the property in the United States, then they have to file a US income tax return, report the income. They get to report all the expenses and deduct all the expenses. They get to deduct the depreciation on the property. But the important fact is that they have to file every year and report the income every year. Now that is for US federal income tax purposes. Also, if they rent the property, every county in Florida charges a tangible tax for the furniture and the equipment inside of the building of the rental property. So that is something that they will have to file as well, a tax return every year, tangible tax return with the county, where they report their tangible assets that are inside the property, and then they get a tangible property tax bill at the same time when they receive their real estate property tax bill. So in October, the county sends out both, and they will receive both. Once they file the tangible tax return, they're required to file the return and required to pay the tax. In addition to those 2 taxes for rental purposes, if they rent the property on a short-term basis, short-term means less than 6 months. So basically all the vacation rentals that you see through any of the platforms, if they do it themselves, it doesn't really matter. All those rentals are subject to sales tax and tourist tax. Now, with most of the platforms like VRBO and Airbnb and all those platforms take care of paying those taxes. If your clients have their own website and do their own rentals, then the taxpayer is required to file the appropriate sales tax and tourist tax returns, and also pay over the taxes to the state of Florida and the county. Sales tax is a Florida tax, state of Florida tax. Tourist tax is a county tax. So be aware of different tax rates for the tourist tax in different counties. With German clients, we often see that they want to form a company to purchase the real estate in Florida. They hear about liability protection, they hear about estate planning, and for those items, they need to consult an attorney. We work with several attorneys, obviously with Christina in reference to that. So you know, when those questions come up, then involve an attorney, but a lot of times it is a good idea to do these things, to have a company that owns the real estate in Florida. There are two items that we need to pay attention to with LLCs, especially with Germans. So for US tax purposes, we want the LLC to be taxed either as a partnership or a disregarded entity, which means partnership, we would have like the husband and wife LLC. Instead of owning the real estate in their personal names, they would form an LLC and they would both own the LLC, and the LLC is the owner of the property. That would be the partnership version. If we have a disregarded entity, we would only have one owner in the LLC. So one person forms the LLC and the LLC owns the real estate. Now for US tax purposes, those two ways are the best way to go because they have the least amount of tax as a consequence of income. So if they rent their property, we get to deduct all the expenses, and then what's left as a profit gets the lowest tax rate possible in the United States, to put it that way. Now, if we do that, that's all good for US purposes, but Germany looks at a limited liability company a little bit differently than we do. They don't know the vehicle of an LLC. So what they have are either regular partnerships or corporations, basically. And in some instances, the German government or the German IRS will treat a Florida limited liability company as a corporation for German tax purposes. And that creates a problem because we won't be able to claim foreign tax credits. If they pay them in the United States, they won't be acceptable in Germany. So it can be a little bit of a problem. There are ways to work against that, and there are special operating agreements for LLCs that can be used for German investors. The safest way to go about that would be to have the client contact the German IRS and get what we would call from the IRS a private letter ruling. Now, that term to a CPA is kind of scary and costly. To get a private letter ruling from the IRS costs a lot of money and takes a lot of time. It is easier in Germany to do that. They would just contact, or their CPA in Germany would just contact the German IRS, explain the situation, show them the operating agreement of the LLC and the documents, the LLC documents, and the IRS, German Finanzamt, would make the determination whether they would allow that to be taxed for German purposes as a partnership, or if they would classify it as a corporation. Now, if they elect or if they decide to do it as a corporation, we will have to rethink what we do in the United States with that. So it's not as easy as just going about forming an LLC and buying real estate. There's a lot more involved in that with German clients. And the way the German tax system works is too, it can be different from city to city, because the German IRS, they have city offices basically. And if a determination is made in one city to treat the LLC as a corporation, that doesn't mean that another city can't treat it differently. So there's no way of knowing for all of Germany that this is the way that it's going to go. Now, I said earlier that a foreigner who generates income in the United States has to file a tax return in the US. So on their rental income, they would have to file a return and report the rental income in the United States. Germany taxes their residents on their worldwide income, which means if a German resident owns real estate in Florida and generates rental income with that real estate, they not only have to file a tax return in the US where they report the income, they also have to report their US rental income on their German tax return. Now, they have to report it, and let's make a distinction here. I didn't say they have to pay tax on it. There is a treaty in place between the United States and Germany that takes care of double taxation. So that means that they do have to report the rental income in Germany. If they did pay tax on their income in the United States, they will get a credit for that in Germany so that they don't pay tax twice, but they are required to report it. And I have seen a lot of people that didn't know that, a lot of Germans that did not know that they had to report it in their home country as well. So that is some information that you might just hand to them and tell them, look, if you have rental income in the US, remember, you also have to report that in your home country, not just the United States. I will touch on two other types of income too. If they have a US bank account or an investment account, they receive interest, dividend, and capital gain income. Based on the treaty with Germany, that income is taxable only in Germany. So they wouldn't be required, first of all, to file a tax return in the US if they only had that type of income. And they also don't have to pay any tax in the United States on that income. In addition to that, I'll talk about flow-through income from US LLCs, since we were just talking about LLCs. So with a partnership LLC, for example, the LLC would generate some income and it would flow through to the Germans' individual US tax return. They would report that here. They also have to report that income in Germany, and it does get classified as rental income if the LLC owns the property, and it is rental income that the LLC generates. So that is also something that they need to know. In general, any type of income that they generate anywhere in the world, really, not just the United States, is reportable on their German tax return. FIRPTA and ITINs. Since Germans are foreigners for US tax purposes, FIRPTA does apply to all German sellers that sell real estate in the United States. Now, it does apply to all of them, provided we do have exemptions from FIRPTA. Exceptions from FIRPTA, we can do reduced withholding certificates. We have a separate webinar from Allure that touches FIRPTA in detail. So if you're interested in that, let me know. If you want some of our flyers, FIRPTA is not the main topic today, but I just wanted to touch base with it and let you know that this is something that we can take care of as well, and that German sellers are just subject to it. So with that being said, a German that sells real estate in the United States will need an ITIN number. ITIN stands for Individual Taxpayer Identification Number. It is a tax ID number that the IRS issues for tax purposes only. It does have the same look as a Social Security number, but it isn't a Social Security number. So all these things apply to Germans as to any foreign person in the United States when they sell real estate. I want to touch real quick on the single member versus the multi-member LLC and FIRPTA, because there's a little tweak to that. Generally, US companies are not foreign persons and therefore not subject to FIRPTA. So that means that, and that is true for a US multi-member LLC or Florida multi-member LLC as well. If we have the husband and wife LLC that I talked about earlier, and both members of the LLC are German, the LLC would still not be subject to FIRPTA because it is a US company. Now, with the way we can tax LLCs and for them to be at some point be disregarded entities, a single member LLC that is owned by a German person is looked at for FIRPTA purposes as if the foreign person owns the real estate. So a single member US LLC that is owned by a foreign person would be subject to FIRPTA. I've seen that a lot of people don't know that. A lot of real estate professionals at the end, when it's time for closing, are totally surprised that this is the case. So if I have a German person that owns an LLC, he's the only member of the LLC, that LLC is subject to FIRPTA, which means you have to jump through a whole bunch of hoops to either get the FIRPTA reduced or whatever needs to be done. That is something to keep in mind for closing. Okay, so that covers what I wanted to talk to you about today. I will open it up for questions. Hopefully you already have written some of them down. As I said at the beginning, here's my contact information with phone number, email address, and everything. If you have questions after the seminar in 3 weeks, in 3 months, in 9 months, I don't care. You can reach out, contact me, ask your questions. I'll always be happy to help you with any type of tax questions in reference to not just Germans, but international investors in Florida and in the United States.
Great job, Marena. I'm going to jump in here real quick. And I want to dovetail a little bit on what you were talking about FIRPTA, and I'm going to let people ask some questions in the chat forum. But it was interesting to me because there's so many little nuances when it comes to FIRPTA that you can't spend all the time on that. But something came across my desk a couple of days ago, and I don't know that a whole lot of people know this. So I wanted you to bring it to light with everybody. So I had somebody that has a, let's say they're Germans, right? And they have a corporation, so it's a C Corp, and their family members are all from Germany, and they all own, or they own all of the stock of the corporation that is now selling this property. Tell us the treatment for that.
Okay, and that one property is the only asset in the corporation?
Correct.
Yes, so technically even that US corporation is subject to FIRPTA because the real estate is the only asset in that company.
Right.
Yeah.
So I think the reason I wanted you to highlight that is because it seems like everything would be similar, or, you know, if you know one type of the answer for one type of situation, you can be totally surprised by the way that another one would serve. And so I just wanted you to highlight that for folks, that they should always make sure to reach out to somebody who knows all of these nuances to have as smooth a closing process as possible, as early as possible in the transaction.
Yes, yes. And there's one other item that I didn't have on my slides as such, but what I've seen a lot too is, you know, when I talk in my FIRPTA seminar, obviously it's all about foreign sellers, but it is really important for real estate professionals to talk to their foreign buyers and German buyers as well. So when they buy real estate, if they just purchase it for their own enjoyment, there's really they don't need a tax return, there's no tax consequences, income tax consequences, but the estate tax problem is still there. So even if there's no income tax and nothing that they have to worry about, when they buy the property, I think they should talk to somebody that can explain what the estate tax consequences might be. Even with gift taxes, I mean, we see it a lot that, you know, the parents buy the property first, and then at some point in time, they decide, oh, we want to add the children to the deed, and they just do that. When they do that, they have just made a gift, and that is taxable in the United States because Germans don't have the same gift tax exemptions as we do as US citizens. So there's a whole...
Marena, let me ask you something with that, because I think this is crucial. And a lot of people, especially foreigners, and a lot of US folks don't really understand, how is the IRS going to find out about that?
Well, okay.
And if you can explain that concisely, that's fine. If not, then that's a topic for another day. But
Well,
that's always the pushback from people. They're like, well, how's the IRS going to find out if I don't tell them?
well, and to some point, I agree. They may not. The thing is, though, at some point in time, people are going to sell that piece of real estate.
Yes.
And at that time, it's an official record. There's an attorney involved or a title company involved, and they won't get around FERPTA. FERPTA is just a fact. So if there has been a transfer before, for example, there's a lot of limitations on what we can do with FERPTA, and you have to show them, the IRS, what happened. So at that point, they could pick it up and say, well, that was what you did 20 years ago with this deed when you added your children. That was a gift and it is taxable, and we want the 35% gift tax.
Yes.
So will they just show up at everybody's doorstep and say, hey, you just made a gift? Probably not. The IRS doesn't have the capabilities to do that, but there's always the risk that it will come out at some point in time. And, there are other ways to do these things, and because what they want to do is they want to make sure that the children get it eventually when parents pass away. So there's and you're the right person to talk to about that. There's other ways to do that versus just doing a deed and transferring rights to the property right then and there. And that's what they need to do, is they need to come talk to an attorney. They need to come talk to a tax person that knows what this is about, and then we'll find a different way that won't get them into problems in the long run.
Yeah, exactly. Okay, so there are a few questions now, and I'm going to go through them if you don't mind. So are we going to be sharing the slides for the presentation?
Yes.
Yes, great.
Elke can send them around to everybody.
Okay, awesome. Next, somebody would like to know, is the FERPTA tax on a condo less than $1 million, but more than 300,000? Is it 10%?
Yes and no. So it is 10% if your buyer is willing to sign the affidavit that they're going to use the property for at least 50% of the time for the next 2 years for personal purposes. What does that mean? That's a mouthful. So what that means is the buyer has to sign a document attesting to that. It does not mean that they need to use it as a primary residence. It could still be a foreign person buying the property as long as they use it 50% for their personal use. So they could use it as a vacation rental even, as long as the personal use is longer than the rental period. So let's say they rent it for 3 months out of the year. They need to make sure that they use it for 3 months and 1 day in those 2 years every year for personal purposes. And personal means themselves or any of their family members. So if they vacation longer than their tenant's vacation, that's fine. They can still sign the affidavit that says, yes, we are planning on using the property in this way that I've just explained for the next 2 years. Then the withholding would only be 10%. So it's not just dependent on the purchase price. It also depends on what the buyer is going to do with that.
And tell us, is it at the end of the year when you look back and you say, okay, well, I did spend, 3 months and 5 days there and I only rented it out for 3 months? Or is it at the time that the purchase is being consummated? At what point matters?
It's at the time of closing, and it's the intent. So when the buyer purchases the property, the intent needs to be for the next 2 years to use it in this way. If at some point in time later, they can't because now, whatever the reason is, now they can't, COVID, they can't be here and use it personally, so they decide to rent it. It won't change what was done at the closing time for FERPTA purposes. So that will remain in place. But obviously they're signing on the penalties of perjury. So at the time of closing, it needs to be the intent, and they shouldn't sign it if that's not what they intend to do.
Have you heard, this is out of curiosity because I have not, have you heard of the IRS prosecuting or following up on that intent and penalizing it in any ways if it didn't?
No.
Okay, good. Okay, moving on to the next question. Sales tax is a county tax versus tourist tax is state, or is it vice versa?
It's the other way around. The sales tax is the Florida state sales tax and tourist tax is a county tax.
Okay. And when does Germany file taxes? At what time of year?
Okay, so their individual tax returns are due on May 31st, so shortly after ours. They do get an extension, I think, until September.
Okay. So you have a busy April, May, and June, August, and September.
We have a busy year all year round.
I'll tell you what, the only profession that gets it worse than us attorneys do is you guys as accountants. Oh, okay. You mentioned that the client in Germany would contact their I guess, respective IRS and request a letter. Please repeat that process.
Okay, so what they would do is they would go to their German CPA and they would do that for them. They would contact the German IRS and send them usually, so for the LLC classification purpose, they would send them the operating agreement, some other documents that show who owns the LLC, what the classifications are within the LLC, and then the German government, German IRS would look at that and make the determination whether they agree to classify it as a partnership, which is what we really want, so that the taxation in the United States and in Germany are the same. So we tax it as a partnership, it flows through to the personal income tax return, and if Germany agrees with that, they would do the same thing, and that makes it match, and then they can take foreign tax credits and things like that. That's what we want. If the German government comes back and says, well, and there's a whole list of items that they look at, and that's too deep to go into, but if they say, okay, we've determined that no, this LLC we don't like as a partnership, we will tax it as a corporation in Germany, then we have this mismatch where we can't take taxes in Germany that were paid in the US and all this, and that becomes messy. So it is a good idea to get the okay from the German IRS beforehand, and that's what how you would do it. You would just contact your German CPA and have them send the documentation in and have that German IRS look at that.
What if one of the German clients doesn't have a German CPA? Can you make that connection for them?
Yes.
Okay. You could supply a coordination. Okay, great.
Yes.
Anybody else, any questions? Send them up on the chat. Let me check the other side. Would you please repeat why the multi-member US LLC is not subject to FIRPTA?
Okay. So for a multi-member LLC that is taxed as a partnership, and that's the default, it will be taxed as a partnership. If a partnership has foreign partners or an LLC, foreign members, there is a different IRS code section that requires the partnership to do withholding on the foreign partners. So since that Internal Revenue Code section covers that LLC is exempt from FIRPTA. So that means that the partnership would have to do some withholding and send some money into the IRS from the sale of the property, but it's not the title company or the attorney's office that handles the closing that would have to do that.
So to recap that, it doesn't have to happen at the time of closing, but instead it's going to happen after the fact when the LLC itself is going through its tax process.
Correct.
Okay, or not taxed, but it will be, I guess, withheld at that point. Okay,
Yes.
Great. Next question, from a property manager's perspective, do we have to send 1099s to German clients on rental income?
It's not a 1099, it's a 1042S, but yes, you are required to send that information into the IRS and also to the client.
Okay. And last but not least, can the partners, I guess this is back to the LLC question and FIRPTA, can the partners be one US citizen and one German citizen?
Yes, absolutely. And it wouldn't be subject to FIRPTA, but the partnership would still be subject to withholding requirements for the German member.
Great. Well, listen, I think that you answered everything 100% effectively. I loved your presentation. Thank you so much for taking the time to be here with us. It's always so great to be able to provide our NABOR members with a knowledgeable and engaging person to be able to, kind of help fill those knowledge gaps that we might have as we proceed through our day-to-day businesses. So thank you very much, Marena and Elke.
There is more, Christina, excuse me, there is more questions in the chat box.
I'm so sorry.
Excuse me.
Let's see. I don't see it I don't see it.
I see it.
Well,
Okay,
then
so
you
I
need
go
to
ahead.
log in.
I go ahead. Give me a second here. Give me a second. Where was the last?
Oh yeah, you know what? I see it. They added it later. Okay.
Yeah.
A German couple has 2 properties. They live in one for more than 10 years. They're selling the second, the always annually rented property. Is this sale subject to FIRPTA?
Yes, well, okay, I have to have a little bit more information. So when you say they live in that one property for 10 years, does that mean they live in it when they come here on vacation, or does that mean they're German citizens with, for example, green cards and live here all year long?
I think that, go ahead and answer both, because I
Okay,
don't know that.
So if they're German citizens and they live in the United States on any type of visa or with a green card, for FIRPTA purposes, they would be considered US residents, US tax residents, if they live here. And like I said, it doesn't really depend on the type of visa. The important thing is they live in the United States and they file a US income tax return like everybody else, meaning a Form 1040, like we all do. Then they would be considered US tax residents and they would not be subject to FIRPTA, even though they're not US citizens. If they live in their first home for 6 months out of the year, they come here to vacation for 6 months or for the winter retirement, and then for the summertime, they go back to Germany. They wouldn't be US residents for tax purposes. So when they sell their second property or their first property, it doesn't really matter. Then they would be subject to FIRPTA on both of them.
Very good. Now, this next, there are a couple questions that were added. This one scares me as a closing agent. Is the buyer on the hook for the FIRPTA tax if the closing agent does not send in tax to the IRS?
Yes.
Yes.
From the IRS's perspective. So what the IRS says is it's all nice that there's attorneys and title companies and closing agents involved, but the buyer is the one that first of all has the money in their hands, and they make the buyer responsible to withhold. So the buyer is even responsible for the withholding itself and then also for sending the money in. So yes, if the closing agent makes a mistake, doesn't send the money in at all or not on time, the buyer will receive the nasty IRS letter that says you owe penalties and interest on a late payment or a payment that's not done at all.
Yes, exactly. Okay. I think I have one more. I'm trying to find one more question. We have an audience member that is trying to ask a question, but it's not coming up. I would tell you, audience member who's trying to ask a question about German clients that you have, I do not see your question here, and so I can't ask it. I would encourage you to reach out to Marena separately by email so that you can ask the question. I wish I could see it here, but I don't. Let me check one more time in the Q&A. Let's see. Oh, here we go. I found it. It's on the other side. And now I'm going to cut off questions, folks, after these couple that I have left. So if you haven't typed in your question, just wait for the next time we bring Marena back. But we have, let's see, my German buyers bought an investment property. Can they deduct renovations?
Yes. Generally, yes. So if it's a rental property, they can take it during the rental periods. And if it's not a rental, they will be able to take it against the capital gain once they sell it. So it's important. That gets me to an important point. Tell them to keep all their receipts. A lot of Germans are not used to having to keep receipts for 20, 30 years, however long they own the property. They're used to having to keep everything for 10 years and then they throw it away because that's what Germany does. Now, when they own property for 30 years, and they sell it, we need to be able to substantiate their basis, which means we need to be able to show what they paid for it and all their improvements, even if it's 30 years ago. So tell them to hang on to their, at least their improvements receipts and you know, the purchase documents and things like that. They don't have to keep every FP&L bill and every water bill, but the big ticket items, the improvements, they do need to save. And they can scan the documents. They don't have to have them in paper form. They can scan them and, you know, put them in a PDF somewhere and save it on a hard drive or whatever they want to do. But we do need those when they sell it.
Okay, great. And this is the very last question. What are the estate tax limitations for a German citizen?
That is a question that I cannot answer like that. It depends on the client situation. It depends on their net worth worldwide. It depends on their net worth in Germany and on their net worth in the United States. So that's something that we need to look at for every client separately.
Great. Again, thank you so much for your time, Marina and Elke. You've done a great job, and we would appreciate having you back in the future. You guys have a great day. Audience members, thank you so much for your questions. They were thoughtful. I can tell that you guys are actively working with German clients, so hopefully this was a very helpful presentation and will help you on your day-to-day operations. Thanks a lot, everybody. Have a great day. See you soon.
Thank
Bye-bye.
you for having us. Have a great day, Christina, and all of them out there. Thank you.
Thank you.
We appreciate it.